new true crime podcast you need to hear to believe.
I need police right now. I've just started broken into my house.
2 men dead at the hands of a teenager and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.
The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague, the man who always misses the Black Friday sales. It's Anthony Macdonald. How are you, Anthony?
Thanks for a reminder, James. Shopping tonight, I think.
Fantastic. This week we ask whether Australia's economy has hit its speed limit. We look at the sneaky big week for corporate deals and preview one of the AFR's big nights of the year. But first, Anthony, we've got some big news here at the Fin Review. Journalism's Night of Nights was on Thursday night. That's the Walkley Awards. And our colleagues were fortunate enough to bag 3 gongs, which is a brilliant haul for the paper. Now, our colleagues Mark DiStefano and Neil Chenoweth won the Business Story of the Year for their expose on mineral resources. The Long Feature Award was won by the Fin for a piece on Fortescue founder Andrew Forrest by Primrose Reardon and Lisa Murray, who you'll know as the host of the Fin podcast. And our data journalists won the Explanatory Journalism Gong for their deep dive into the world of philanthropy and charity trusts. The team there included Lucy King, Josh Peach, Brian Cook, and perhaps most relevantly for our pod, also Fiona Buffini, who, for anyone who sticks around for the credits of our podcast, will remember she's the head of premium content here at the Fin, and also one of the greatest journalists Anthony and I know. So massive congratulations to everyone, and a special congratulations to Fiona. A huge amount of effort over many years, justly rewarded. So how good, Anthony? 3 awards, pretty good haul for the Fin.
Sure is, James. I mean, Fin's been on fire the past few years. Definitely a step up in the Walkleys. You know, from my time, 15 years at the Fin Review, the past few years they've been flooding in. So hopefully that's a good sign. You know, sign the journalism's getting better. We're having more impact, which is great. You know, congrats to all the winners this year. I mean, for me, as a corporate news hound, special congrats to Mark DiStefano and Neil for the mineral resources piece that won Business Story of the Year. Like, often this Business Story of the Year can go to something a little bit esoteric or something that we think's a little bit outside what we would think about as a business story. I mean, but this one was smack bang, right down the heart of it. It's had impact, big sort of names involved and powerful people that they've gone after with some really tough reporting as well. Sure copped a lot of flack.
And most importantly, Anthony, it's given us plenty of columns to write.
Yeah.
Which is extra good.
Yeah. All right, James, let's stop patting ourselves on the back and jump into the pod. We've got a stunning intervention into the housing market this week. APRA, the bank regulator, has clamped down on bank lending to homes for the first time in more than a decade, restricting the volume of highly leveraged mortgages in the bank's overall loan books. James, you highlighted this coming last week. Has APRA spotted something it doesn't like here, or is it just a bit of a warning shot?
No, APRA's spotted something it doesn't like. APRA's got a view that the falling rates environment sparks the start of a new risk cycle, and that risk cycle, from APRA's point of view, means that when money gets cheaper, people take more risk, they borrow more money. Now, APRA has been really taken aback by how fast house prices have moved. When house prices move that quickly, what do you need to do when you take out a loan? You need a bigger loan. We're going to need a bigger boat. And so what we've seen here is APRA looking particularly at the investor loan growth. It's running at its fastest rate in a decade. I think because a lot of investors have tried to get in before the first home buyer deposit scheme really kicked off. That started in October, so we've seen from August, September, a lot of activity from investors. And so what we've seen is APRA come in and try and really launch a preemptive strike. They want to get on top of this before it becomes an issue, which I think is totally fair enough. So what we've seen here is the new lending flow. So new loans, only 20% of those on both the owner-occupier and the investor books. Only 20% will be able to be written at what's called above 6 times DTI. So that's the name for loans where the lender's income is less than 6 times the value of their loan. So think about it. If you're on $100,000 and you're borrowing more than $600,000, APRA are saying they're concerned about those loans. They see them as higher risk, and they're telling the banks to put a cap on that type of lending. Now, actually, we're not all that close to those limits at the moment. For investors, about 10% of new loans are being written at 6 times DTI or above. For owner-occupiers, it's only 4%. So that's good. We're not anywhere near the limits, but APRA is looking at the investor loan flow and seeing some very big and risky loans there, and it just wants to put its foot on the market and say, nah, had enough there.
I was speaking to a mortgage broker about this at the school assembly this morning, and he said there's definitely a pickup the past 18 months of investors coming in and with these highly leveraged loans, expecting that the rates were going to go down even further, so they wanted to get set. If rates go up, it might take some of the heat out of the market anyway, but I mean, these restrictions are clearly there as a bit of a backup in case the rates environment doesn't just do it for them. Yeah,
that's exactly the right way to think about it, Anthony. John Lonsdale, the APRA chairman, he used the word guardrails. We're not anywhere near these guardrails yet, but we are not going to sit here and let this run. We're going to draw a line in the sand and just let everyone know. I think you're totally right about rates, by the way. We'll get onto the rates picture soon, but you don't even need rates rising to take heat out of the market. Just rates standing still, holding for the next little while. That'll help do APRA's job for it. So it's probably a bit of a double whammy coming for the housing market with APRA and the rates on hold, just taking a bit of heat out of things.
And what about the big corporate story on Friday, James? Corporate Travel, as the name suggests, the corporate travel agent, has been listed on the ASX for about 15 years, worth a few $1 billion. It's had its accounts in question for months now. It's got a new auditor, KPMG, which has been poking around its revenue recognition, which is a key audit matter for a contracting business like corporate travel. And judging from this morning's statement, James, it's going to require serious changes to its revenue line for the FY25, the year that's just gone, potentially for a few years before that. James, corporate travel's had its shares suspended since August, trying to sort out these accounts. Looks to me like they're still not sorted out. Is this serious news or what?
Anthony, I can feel the former auditor in you just champing at the bit here, and fair enough too.
Love it.
Let me just correct you a little bit. KPMG has been brought in at the guidance of the original auditor, which is Deloitte.
Yep.
Now, Deloitte still hasn't finished its audit of the 2025 accounts. And what we've been told since August, basically, there's a revenue recognition problem, which when you say it, sort of, it goes, okay, it sounds technical, doesn't it? Revenue recognition. What we've learnt today is it's not revenue recognition. Corporate travel management has been overcharging its customers. It's been ripping off its own customers.
Just revenue.
Yeah, it's just straight revenue rip-off. Now, they haven't named any of those customers, Anthony, but its biggest customer in the UK just happens to be the British government.
Uh-huh.
Not a great look to be in trouble with the government of your base. We're talking revenue overcharging, which might be the polite way of calling it, to the tune of £80 million, which is about 163 million Australian dollars. Mm-hmm. Now, the good news is that corporate travel management's got about 143 million bucks in the bank, so it can meet these customer refunds that it's going to have to make. It's got no drawn debt. It's saying its solvency is not a problem. But Anthony, we know how this is going to go, right? Eventually, this stock's going to come back onto the market. The audit will finish. The shares will trade again. Where do you think the shares are going? They're going down like a little kid on a toboggan. They are flying down the mountain. And then this company, if there's anything worth picking off, as if its competitors aren't going to be circling saying, maybe we can grab this thing for a song and just take the good bits of it. So they're in a real fight for survival now, I think. They're saying, look, it's quarantined to the UK. There's no great issues in any other parts of the business. We're talking to our customers. We're reassuring everyone everything's going to be okay. But they've stood down their UK CEO immediately pending a further investigation. I think it's very difficult to see that you don't get further heads rolling as the investigation is completed. This has been happening since 2021. So 4 years. that the board and management team were, couldn't quite figure this out. That's just a disgrace. This is a train wreck of epic proportions, and these things don't tend to end very well.
And of all the companies for it to happen to, James, corporate travel, it's one that's had short sellers and the hedge funds picking around its account for probably 10 years now. Turns out there might actually be something there.
Well, yeah, you're totally right. They survived a short attack in 2018, fought it off really, quite strongly. But this issue is clearly deep-seated. They've got a massive governance problem. They've got a massive revenue problem now. This is going to get pretty ugly, I think.
One for your end-of-year list, James.
Yeah, the good, the bad and the ugly. It's just a question of whether it's bad or ugly at this stage, I think. Okay, Anthony, let's move to our first topic of the week. And on Wednesday at 11:30, one of the final nails was placed in the coffin of next month's potential interest rate cut when monthly inflation data showed prices are rising at 3.8% or 3.3% when you strip out noisy items like food and energy. Now, neither figure is anywhere near the RBA's inflation target band, which is 2 to 3%, and so rate cuts are off the agenda for now. And some economists are tipping rate hikes as soon as May. Anthony, you've been on the RBA on hold bandwagon for a while. What do you make of this? Could the next move in interest rates really be up?
Well, we're at 3.6%, James, and it's really not that high. Like, seriously, I've just never understood the expectation that rates have to be lower. Look back in history, rates were lower than 3.6% only for about, 7 or 8 years leading into the pandemic and then the pandemic era. But go back any time further than that, they were seldom ever below 5%, right? So
good point.
You got to remember that like 3.6%, if you're a borrower, it's not actually that bad. It doesn't feel that restrictive. We're now at the situation where people are like, 3.6%'s, too high for the households, too high for businesses, too high for the economy. But like too high says who? Maybe we all just have to get used to rates being at these sorts of levels, James. Like money costs something. Money should cost something. Taking risk should cost something. And if you're borrowing, whether you're a business, household or whatever, you should be expecting to make a good enough return on that to cover your risk. So
toughen up.
In terms of your question, James, could it be up? I mean, yeah, absolutely. But I think if nothing else, we've sort of broken the back of this expectation that the next move has to be lower.
Yeah.
It has to be soon. And Australia needs sub 3.6% to just fly. Michelle Bullock, the RBA governor, I mean, her sort of positioning around this 3.6% levels noticeably changed in the past couple of months. So 3.6% was always restrictive, putting a bit of a brake on the economy. In the most recent rates decision, she sort of flipped that and was like, hang on, 3.6% might not be restrictive anymore. Maybe it's neutral. So it's all interesting, James, and it all comes back to inflation. Why has Australia got an inflation problem again? I thought we slayed this dragon.
No, we didn't, Anthony. And the problem's productivity. Shout out to Paul Bloxham. He's the economist at HSBC, former RBA official. He's been talking about this for the best part of a year. And that's the idea that the Australian economy's got a speed limit. Because productivity growth is so crappy, the economy, as soon as it starts to grow just a little bit, as soon as our toe is on the accelerator, inflation spikes up again.
Yeah.
So the RBA's had this forecast for productivity growth at 1%. The Treasury in the budget has got a productivity growth figure of 1.2%. But productivity growth in the last decade has been 0.3%. We love kidding ourselves about this stuff. I don't know why. We just can't face the reality. But this is what happens. Crappy productivity growth means that when the economy grows, we hit the speed limit and inflation kicks up and interest rates have to be either on hold or move higher. So that's the problem that we've got. I think it's become really clear now. Ball's in the government's court to some extent. I mean, I think that'll be a message from Michelle Bullock at the RBA press conference next month. We've done a fair bit of work to get inflation down from 8% to 3.8%. But look, now we need a bit of productivity growth. This is not just theoretical now. We are seeing that if we don't have productivity growth, it really matters. I think she'll be more polite than that, of course. But Anthony, speaking of productivity, almost at the very moment the monthly inflation data was coming out, you were on stage hosting a mini productivity summit for the AFR on Wednesday. Did you come away from that event with any sense of how we can get some quick productivity wins or even some long-term productivity wins? I'll take anything.
I've got the usual, James. The same things CEOs have been banging on about for years. The same things they were hopeful Jim Chalmers would address at the Economic Roundtable in August. The same thing the Financial Review's probably been campaigning about probably forever. And I'm sure you could guess what they are. Cut regulation and red tape, particularly when it comes to planning approvals. I mean, what's changed, though, I guess, is who was saying it this time. So we had Robin Cooter, the Air Trunk founder, there. And Robin was very fired up. I mean,
good.
You look at him and you can imagine he's easy to underestimate, right? Like he turns up, he's got this big smile, he's got this pretty gentle and friendly sort of nature, but boy, he really packed a punch. And, you know, Air Trunk's an Australian business. They're developing the data centres. Its first data centre was right here in Sydney. Its portfolio is still anchored around its Australian assets. I mean, Cooter's a proud Aussie. I mean, most of his staff are as well. And you can tell he wants to do more business here. Yet he struggles to make the case stack up, you know, compared to the Asian markets they're investing in, Singapore, Malaysia, in the Middle East, Saudi Arabia. You know, he says it takes 16 to 18 months longer to develop a data center in Australia than in Asia. You know, that's 16 to 18 months of more uncertainty, 16 to 18 months longer to offer a customer a proper contract, 16 to 18 months you're holding capital, you know, against the development and just spinning wheels on it. And why? He says it's the planning approvals. Big approvals obviously are power and water. But the fact that Robin says the government doesn't even know it wants out of AI in general, let alone data centres, isn't helping. And he's also worried about the tax environment. You know, the cash flow tax, where did that come from? Is it happening? Where's it up to? I mean, I interviewed him for 20 minutes and he was just like one foot in front of the other the whole time, you know, bang, bang. And he says he's constantly talking to the government about this stuff and delivers his message tactfully and respectfully. You know, you always catch more flies with honey than vinegar. You got to love these founders though, James. I mean, they're not perfect, far from it. And I'm not saying we need to create tax havens for a private equity owned company like Air Trunk or billionaire Robin, like far from it. But it's great when someone stands up and tries to outline just how hard it is to do business in Australia.
Yeah.
You know, particularly for something like this in data centers and AI, James, like clearly this industry is about to really take off. Do we want to be part of it or not? Do we want it here in Australia or not? I thought it was really interesting. And just lastly, James, I just wanted to, also on the productivity, we had number 2 from the Productivity Commission, Alex Robson.
Yeah.
He had a very interesting way of describing productivity.
Okay.
He says the average Australian creates $110 worth of value for every hour of work. So if you look at just the GDP divided by the hours worked, $110, James. So this pod, half an hour, 2 of us, a couple of producers. You know, we need to be...
I'll stop you there. Yeah,
a couple $100 worth of value. But basically the $110, I mean, that's unchanged from a decade ago.
Right.
That's the problem here.
That's what we need to get up a bit.
We need to get more value out of every hour worked.
Yeah, that's a nice way of thinking about it.
Which would be good for everyone. James, I want to bring in a question here, which came in via the widget you'll find on all our Chanticleer articles on afr.com. And that's from Indiana in New South Wales, who asks, do you think our productivity problem is actually a capital allocation problem created by our tax settings, market structure, and the incentives built into super funds? What do you reckon?
I think that's possibly a contributor to the broader problem. I mean, tax settings are important. I think genuine tax reform that allows people and businesses more flexibility and more dynamism, that would definitely be helpful. So I think that's part of it. But there's lots of things we can do here. There's big ticket things like tax reform. But this planning stuff, geez, it irritates me. Like, we have gone to summit after summit after summit, and it's across energy, it's across infrastructure. Property. And we hear the same things every time. The planning system's stuffed. Nothing works. Nothing gets through. Everything's so slow. Like, seriously, I don't want to repeat myself, but it's clear we've got something approaching a crisis in this area. Why don't we take a crisis mindset to trying to fix it? Instead, we just seem to spin the wheels and get nowhere. So that's the low-hanging fruit. That's the thing we could change in the next 6 months to really start getting things happening. And you can see we need lots of things to happen. We need houses to be built. We need renewable projects to be connected to the grid. We need to get on this data center train. Let's do it. We all know we've identified the problem. It's so bloody clear. Let's do something about it. Is there a capital allocation problem, as Indiana suggests, in addition, that we need to be thinking about?
I definitely think Indiana's onto something here, James. But remember, productivity's been cooked for a decade. And the way that super funds are incentivized to invest through the performance test, it's only been the case for the past few years. So the rot set in way before that. Do I think it doesn't help now? Like, absolutely. It's a shocker. You have funds actively encouraged to invest in companies based on size and index positions, not who is the best prospect, who's the most efficient allocator of capital, who has the highest margins or whatever. So, I mean, the super system's great, but I do think it sets in some conservatism and complacency too.
Yep.
Risk aversion, something else that Kuda was banging on about on stage. He thinks we're a risk-averse country. People are too scared to fail. And James, I keep thinking about the inheritocracy piece you wrote about 6 months or so ago. The more Australians have, the bigger their nest eggs, the more conservative they are with their money. They just want to park it somewhere safe.
Yep.
Make, 5, 6, 7, 8% a year, whatever, rather than really putting money to work and really going for it. And that's a mindset thing, I think, because, if you look at the US, there's way more wealthy people in the US, right? Yet they have this real productivity culture over there. So I think just because you have money doesn't mean you have to be conservative with it in a way. But yeah, there's a lot going on.
Thanks, Indiana. Great question. It's one that's on all of our minds. So keep your questions coming in. It's a thorny problem and we're not going to solve it quickly, but let's just have a crack at fixing something, please.
Okay, James, we know that Santa must be getting ready for his big night because the late year flurry of deals is well and truly on. We've had an extraordinary week. Bids for IVF Group Monash, self-storage properties owner National Storage REIT, 2 bids for Webjet, a bid for big infrastructure logistics company called Cube, and another massive bid from mining giant BHP for Anglo American. James, let's start there. This is the second time BHP has had a crack at Anglo, and the second time they've had the door shut in their face. What happened?
Oh, they just can't get anywhere with Anglo BHP. But look, this is about copper.
Yeah.
The electrification of the economy, data centers, all that stuff. We've talked about that before. Anglo's got some great copper assets, particularly in Latin America. BHP wants more great copper assets, so it's had 2 cracks at buying this thing. You can't fault BHP for doing this. They've got terrific copper assets too. But there's some projects in there that are long dated. They're going to take decades to bring to fruition. Buying Anglo gets them more copper tomorrow. And so they've had 2 cracks. Now, Anglo's about to merge with a company called Teck, a Canadian group. And so BHP's clearly thought, this is our last chance. We've got to rush into the church. And when the priest says, does anyone have any objections? We need to put up our hand. And that's what Mike Henry's done. But unfortunately, he's got no love from Anglo. They've shut the door on him pretty quick smart. It's interesting, isn't it? I said they look a bit desperate having had 2 cracks at the same target that doesn't want anything to do with them. But you can understand why he's having a go because the copper story is just so big, isn't it?
It is, James. It's huge. Going back to it, I mean, obviously, it's a bit of a bad look. BHP would have preferred this didn't get out, I'm sure.
Yeah.
But, if you're a BHP investor, are you now worried that BHP maybe doesn't have the copper portfolio that it would like to think we have?
Yep. Ethnic, can we just zoom out a touch, though? Why in a sort of nondescript week at the end of November do we get this big flurry of deals? I mean, it's been quite extraordinary. Is this like a seasonal thing? Has something shifted in markets that I haven't noticed? I mean, you're our deals master. What's going on here?
It's seasonal, James. You hear those sleigh bells ringing. There's a few weeks left in the year. If you've been cooking up M&A plans and you want to get them moving prior to the month-long corporate Australia break, it's sort of now or never.
Yeah.
It helps that markets have come back a fraction, sold off a fraction. That always makes boards a little bit more realistic about their valuations. They're not thinking their share price will go up forever and can encourage bidders to come forward. It's also a sign of the times, James. Like M&A has been gangbusters in the US this year. It's been okay in Australia, hardly a record-breaking year, not terrible. I mean, if the Santos deal was still alive, we'd probably say it was an above-average year. Now It feels like probably an average year, and that's okay. But with debt markets strong, rates reasonably settled, the economy okay, the earnings environment okay, Australia's still having this safe harbour glow and the sort of sovereignty advantage around it, which attaches us to, Japan and the US and the Western world countries. The Australian dollar at 65 cents, it's still pretty affordable. It's game on time. And that's the nature of business these days. Companies everywhere out there trying to grow their earnings. often they fall into the trap of trying to buy it rather than do it organically. They think that's easier. You've got all these private equity funds that have raised heaps of money that need to put them to work. So, yeah, there's a lot of people out there chasing quick wins.
Yeah. Is there any patterns in the deals we've seen this week? I mean, I sense a lot of private capital is sniffing around our public companies again. Is there a deal that sort of tells the story of the week?
There is, James. I mean, I've got to go for the biggest one. I mean, if you ignore BHP's 11th hour attempt to get Anglo talking, the biggest one is Cube. I mean, Cube owns a lot of the port-related infrastructure around the country, so it's got a half share in Patrick, which is one of the big container businesses, and it's got a heap of other sort of logistics and handling businesses. You know, for example, transporting grain and exporting grain out of the country. Now, its deal sort of touches all the hot points, right? It was $11.6 billion, including debt, so it's a big banana. But if you look who's trying to buy it, it's Macquarie Asset Management. So Macquarie Group, their funds management arm. So it's private capital chasing infrastructure-like qualities. There's more money for this stuff in private hands than there is in listed markets. It's got the sovereignty angle, right? This is Australian asset manager chasing an Australian business. Very, very important in these times, James. It's got the sort of like trade and regionalisation of trade angle. This is a business that makes money importing and exporting Australia within the sort of Asian region, which is very important, right? We're hearing lots about sort of like regionalisation of trade rather than perhaps, you know, everyone in the whole world trading with each other all the time. You know, it's got the demographics angle, you know, Asia getting wealthier, sort of trading more, maybe buying more, you know, protein out of Australia or whatever. It's got debt. There'll be heaps of leverage in this thing, James. Debt markets are good, though. Banks are desperate to lend. Private credit's an option. If Macquarie stacks up this thing in due diligence, you can expect there will be a monster of a debt package here. And dare I say, it's also probably got a big super angle, James. Like Macquarie turns up, it doesn't have all the money itself, even if it pulls on the debt. So it's got a bunch of co-investors who will be doing due diligence at the same time it is. And I would be astonished if there isn't at least one big Australian super fund lined up as a co-investor. So, James, if you look at across our list of deals there, they're all sort of private capital related. I mean, just if you broaden it out, it's the past month. We got AUB, an insurance broker, $5 billion, 2 private equity firms chasing it. You got your Monash one, that's private equity. National Storage REIT, that's Brookfield and GIC, that's private capital. Infomedia software business just went to TBG, private equity. Lynch Group sells flowers in Woolworths and Coles, just went to private equity firm TBG. Iris is in play. It's got private equity on its tail. Nearly lost Santos to private capital. So, you know, it's
one-way traffic.
All about valuation. These things are worth more in private hands. Sometimes because it's a turnaround job and listed markets don't have the sort of runway. Sometimes because of contracted revenues and infrastructure like properties that mean a private capital owner can just pump it full of debt a lot more than you can in private markets. Or sometimes it's just because these private assets, the shares don't trade up and down every day. So the big real money out there, the super funds, they like them because they're smooth in their valuations. So it's a big issue globally. James, get your crystal ball out.
Yes, I've got it here. Yep.
You got it here.
Polishing it as we speak.
What does 2026 bring for deals? I'd say 2025's been okay in Australia. Bumpy year offshore. What about next year?
I'm torn here, and that's a bad thing. The crystal ball doesn't allow you to sit on the fence. It's it's round, of course. But I guess I'm thinking of two things, Anthony. In one sense, what all the market strategists are telling me is that earnings are going to pick up in the next 12 months. I think earnings growth predictions are like 8% for the ASX 200. And so that'll take a bit of pressure off the valuations, gives companies a bit of growth. I'll be able to say to investors, hey, we don't need to go out and buy growth. It's coming through here nicely now. So that says to me maybe there's a little less pressure on deals. But I think I just come back to this private capital thing. To the point you just made, there are just lots of businesses out there that are easier to manage, that are more valuable in private hands. And I think that drumbeat will continue. So I think we should have a reasonable year. There's some sort of medium-term clouds over the Australian economy that we're all talking about, productivity being one of them. But the next 12 months should be okay, I think. Yeah, okay, interest rates aren't going to fall, but to your point, that's not a sign of a weak economy. That's a sign of an economy that does have a little bit of momentum. When times are good, we tend to see deals happening. So I think we can have a reasonable year for deals. You're an M&A old hand. What do you reckon?
My crystal ball's telling me this shrinking ASX story, James, definitely not going away. This private capital is a train. Don't hop in front of it. Even 8% earnings growth, if that happens, I don't think that's enough to save ASX companies from themselves. These businesses, like I said, they're just worth more in private hands. The big one, the big question is whether we get a few IPOs back to restock the ASX. I mean, the big exciting one at the moment is Thermos, the NeoCloud data center provider, which we've spoken about a few times on the pod. James, I'm going to put it on the line and say it won't IPO.
Really?
If it is the real deal, it's going to get funded privately.
Wow.
For sure.
Okay.
There will be some other PE, private equity-backed IPOs. Green Cross is, I'd say, the most likely, the pets and vets business. But I'm watching for some Australian companies to do some stuff next year, James. And how can you go past BHP?
Yeah.
Clearly, it's got the copper itch.
Yeah.
Just because its favourite target's going to be melded in with tech. Well, I mean, watch Westfarm. It's been a while now since it did something big. Its newest divisions, health and lithium, not going gangbusters. I mean, lithium will get better as the price gets better. Watch Ryan Stokes' SGH. It's flagging that it wants to buy something. So I don't know. I think there'll be plenty on.
Well, Anthony, we haven't quite received a takeover off here at the Chanticleer podcast yet, but we're going to come back after the break and talk about the AFR's Night of Nights that's coming up on Wednesday. Back in a sec.
A new true crime podcast you need to hear to believe.
I need police right now. I'm just stabbed and broken into my house.
2 men dead at the hands of a teenager and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.
As we fly towards the end of the year, I want to say hello and thank you. I'm Alex Gow, Head of Audio at the Financial Review. Chanticleer is just one of several excellent podcasts we make, and I encourage you to check them all out. From our weekly news podcast, The Fin, where we take an in-depth look at the paper's biggest story of the week, to How I Made It and 15 Minutes with the Boss, where we speak to the most influential names in corporate Australia. Thanks again, and we look forward to bringing you more from Anthony and James in 2026.
Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, big week ahead. Wednesday, GDP growth figures. We'll see how much of the foot is on the accelerator here. The predictions for 2.2% growth, which ain't bad. But look, just interestingly, Australia's growth estimates from UBS is 2.2% for next year as well. Mm-hmm. That's actually the best in any developed market. So we shouldn't be too down on ourselves, should we?
Yeah, we're going all right. But be careful what you wish for, James, because we've learned as soon as the economy's growing, inflation's going up. So
good
we just
point.
can't win.
Good point. Now, Wednesday night, I'm really looking forward to this. The Business Person of the Year Awards. We've got a cocktail function in Sydney. We're going to announce the names. Anthony, can you give us any hints?
Well, I'm sworn to secrecy, James, but can't help want to give the Chanticleer podcast listeners something. Like these awards, we love the founders, right? So we're looking for people that have founded business, someone that's made something, taken risks, achieved something that others haven't. I think we're also looking at a few corporate Australian, celebrities, people that run businesses really well. We traditionally give about half a dozen awards out. I mean, last year, you'll remember the top gongs, it was split between Robin Cooter at AirTrunk, who founded AirTrunk, and then the Chemist Warehouse crew, Mario Verrocchi and then Sam and Jack Gance. So we're looking to celebrate really successful Australian business stories.
Stay tuned for next week. We always love to bring you some of the drama and the great stories from inside the room, so we'll make sure we do that. And on Thursday, Anthony, Bendigo and Adelaide Bank have an investor day. Now, you talk about crappy weeks. Poor old Bendigo, they had a tough week. On Monday, they disclosed that they have a money laundering problem. Not their money laundering money, but their anti-money laundering processes and systems aren't up to scratch. I think the shares fell dramatically, about 7% on the day they announced this, because investors are thinking fixing those problems is going to cost money, and banks have a big cost problem at the moment, don't they?
Yeah, it was a doozy of an announcement, James. Something you don't see every day. It looked like Bendigo Bank, poor old Bendigo, trying to get out ahead of a regulator or something like that, disclosing it on them. So, yeah, good luck to them getting through that. And then to do that 1 week before the investor day, it's pretty unlucky.
Yeah, a lot of questions will be asked next Thursday. All right, we love questions here on the Chanticleer podcast. We had a question earlier from Indiana, and we've got another question from Joshua in Essendon. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone and include your name and where you're from. And, of course, the widget on Chanticleer articles at afr.com is another way to get in touch with us. So Joshua asks, I've been hearing a lot recently, including from you last week, that AI bubble fears have kicked up a notch, especially now the hyperscalers are funding their data center build-outs through debt. It got me thinking, if someone wanted to establish a defensive position in AI, isn't buying the debt of the hyperscalers an interesting angle? Do you know if retail investors have any practical way to access this kind of corporate debt? It's not easy, is it? AI debt is a big institutional game at present.
Joshua, come step into my office. Seriously, mate, what Joshua just asked, I mean, every stockbroking firm out there, every financial advisor, all the fund managers, there is a pricked up to this, right? They know there's plenty of Joshuas out there who will be looking at this AI opportunity, looking at the private credit that's going into it and saying, how can I invest in this stuff and make my, 5, 6, 7% a year yield? So Joshua, I would be astonished if we don't see in the next year or two, some of these big fund managers come in and bankroll, whether it's Australian data centers or the offshore ones, and then look to raise money here in Australia against that. So I think this is definitely coming. I think this market for buying into the debt stack of the big hyperscalers will definitely open up. And the fact that, Joshua was asking questions about it, brokers don't wait for these sorts of questions. They'll be working on something already.
Yeah. So just to be very clear, we can't give personal advice at all or any sort of financial advice. But some people have taken the approach of buying the equity in the companies that manage this debt. In America, there's several like Ares and Apollo Global Management. Blue Owl is another one. They've just done a series of big debt deals with Meta platforms, including arranging a $30 billion US debt package for one of their big data center businesses. So you can buy shares in those companies as a way of getting exposure to that debt story, I guess. The good news with Blue Owl is there's been a bit of skepticism about their involvement in both private credit and AI private credit. The shares are off about 40% since the start of the year. So they look a lot cheaper than they once did. So, but that's another way to play it. A less direct way though. All right, Anthony, I will see you in Sydney on Wednesday for our Business Person of the Year Awards, which is always such great fun to see these entrepreneurs and celebrate some of the great names in Australian business.
Yeah, it's great function, James. Another sign that the year's wrapping up. So look forward to seeing you up here.
Fantastic. And thanks for listening. We'll talk to you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Alex Gow and Mandy Coolin. Our theme is by Alex Gow. Head of Premium Content is Walkley Award winner Fiona Buffini.
Hello, it's Mandy here, one of the producers of the Chanticleer podcast. Thanks for listening all the way to the very end. For our last episode of the year, I'd love to put together some voice messages for Anthony and James from you, our loyal chook-loving listeners. So why don't you send one through and tell me where you listen to the podcast? Is it on your weekly run? Is it in the shower? Maybe when you're mowing the lawn? Send us a voice note, tell us where you listen, where you live, and your first name, and I'll surprise the chooks in our final episode of the year. You can email your note to chanticleer@afr.com.
The Australian Financial Review.
A new true crime podcast you need to hear to believe.
I need police right now. I've just stabbed and broken into my house.
2 men dead at the hands of a teenager and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.